Japan currency crisis, crash.
When currency traders used to consider it a safe haven. So why is the yen so weak?
The Japanese yen used to be the go-to place for forex traders seeking shelter when markets turn stormy.
Over the past year, the world's third most traded currency has lost over 20% of its value against the dollar. On top of this, many strategies predict that the yen value will continue to plummet against the dollar, as the fundamental reasons behind the fall have yet to be addressed. One of the direct consequences of the persistently weakening yen is stronger inflation as manufacturers face a higher input cost and an elevated import goods price. The depreciation in the value of the yen has raised concerns amongst many who often invest in the Japanese yen as a safe haven whenever there is a currency crisis, due to its relatively stable nature for decades. Why is the Japanese yen crashing? This year, the yen's performance is the worst among the currencies of major developed economies. So many factors contributed to the weakening of the yen, especially the pandemic and the conflict in Ukraine. Despite Japan's government having expressed concern about the rapid fall in the yen's value and even announced the government would likely intervene if necessary with the hope that they would stop the yen's decline, it seems that alone was not enough. These are the largest factors that led to the crash of the Japanese yen. Differences in interest rates in Japan and the US. This year alone, the US Federal Reserve has increased its main interest rate between the first and third quarters from 0.25% to 4%. Since March of 2022, the main interest rate has seen an average of plus 25 rate change, BPS, at least each month. In contrast to Japan's interest rate, which in the fourth quarter of this year sits at negative 0.1%. According to experts, the reason for the surge in the US's main interest rate is its attempt to tackle the rising cost of living. And with the US having such a high interest rate compared to the yen, investors are more attracted to the US dollar. As a result, there is less demand for the yen because of its low interest rate, causing a fall in its value. Economic stagnation. Another reason contributing to the decline in the yen's value is its economy. The economy only experienced a 1.62% growth in the past 3 decades. Truthfully, Japan's economy has been stagnant, which can be attributed to the fact that the country is one of the world's most indebted nations. It holds about 235% of its GDP in debt, which amounts to about $1.3 trillion in US Treasury securities as of May 2022. The negative and low yield in Japan makes holding US debt attractive. In addition to these predicaments, Japan faces the demographic ticking time bomb of a low birth rate. As a country with the world's largest population of older people, it is only a matter of time before its population cannot maintain economic structures. However, the government plans to mitigate this challenge by easing its immigration laws to allow more foreign workers into the country. The shocking rise in oil prices in Japan. Japan is one of the world's largest consumers of oil. It consumes an average of 4,012,887 barrels of oil daily and produces only 123,525 daily. As such, it must import an average of 3,146,668 barrels daily. Japan relies on crude oil imports to power the nation, and the recent increase in the price of crude oil is not helping matters for the economy. In the first quarter of 2022, the price of a barrel of OPEC basket crude oil reached an all-time high this year of $126.51, compared to a price of $68.18 per barrel in the first quarter of 2021. For Japan to purchase crude oil because of the petrodollar agreement, it must first convert its currency to the USD. And with the value of the yen declining, purchasing such a significant quantity of an essential commodity is not helping the currency's value. What has the government done and can do to stem the declining value of the yen? Increasing the main interest rate is a clear solution that will help the yen attract more investors. But on the contrary, Japan's economy is just too weak to handle higher interest rates, according to the governor of the Bank of Japan, Haruhiko Kuroda. The current bank policy is necessary as it helps the economy reach its targeted inflation rate of 2%, because in the past, Japan has faced deflation, where consumers tend to hold back spending in hopes that prices will drop further, which reduces the amount of money in circulation, thus hurting the economy. Furthermore, in an attempt to prevent the yen's continuous slump, the government saw it prudent to intervene. In September, the government spent $21 billion of its dollar reserve to buy the yen to slow down the yen's decline, which was the first time the government stepped in since 1998. Since this strategy was short-lived as the currency tumbled again, Even worse, this time crossing the 150 yen to a dollar mark. This fall reportedly triggered another intervention from the government, with an estimated use of $37 billion from the dollar reserve. While the Japanese government has a foreign exchange fund account with up to $1.3 trillion, there are only so many times it can provide such intervention. Much of the Japanese foreign exchange account has been invested in US government bonds, meaning there's only so much it can liquidate all at once. The recent decline in the Japanese yen has already hurt and will continue to hurt Japan's economy. As a result of the currency losing its value, importing oil and other commodities will continue to be expensive until the Japanese yen regains its value.